Hey guys, this is Scott Horne. This video, we're going to take a minute and just talk about, myths about owner financing that can really cost you a lot of money if you don't understand things. So hopefully you'll like this video. If you do, take a minute and like it, please. Don't forget to jump over to our YouTube channel, subscribe. If you got any comments, comment below. Do our best to answer those for you. So guys, owner financing is an awesome tool that truly, I believe, is one of the greatest wealth builders in the marketplace because it has one of the paths of least resistance. Now, so many investors get into our industry with one thing in mind, that is to make money today. And they lose sight of what I always say is the real part of our business. That is, we are real estate investing. We're not real estate job, and I don't want to make this too much of a real estate job. Being a realtor is a job. Being a wholesaler is a job, because every time you sell that one property, it's a one and done strategy. You got to start back over again, and you lose sight of how to create and generate wealth and really long-term income through reoccurring positive cash flow. And investors think that the only way to do that is to flip a house from a wholesale perspective, the contract, whatever it might be, maybe do that fix and flip. And guys, you can do that and you can make money along the way. But the true goal is to sit back and generate long-term wealth. Wealth through equity, wealth through cash flow that is always there for years and years and years out there. So many people think, though, that if you're going to do a seller finance transaction, that first off, you're dealing with low-end buyers who just can't qualify for anything else. Absolutely not. Think about this for a minute. A lot of buyers have to put 20% down. No, I grant you again, the average down payment might only be 5%. I get that. But by the time you get run through the ringer with the mortgage company, you pay all their fees that go along with buying a home through traditional mechanisms, you're already paying a 10% down payment out there. So there's a ton of buyers who have money to put down who just don't want to mess with mortgage companies for all types of reasons. And again, maybe there could be some minor credit challenges. And from credit challenges, I mean maybe they are self-employed, which has always been a double-edged sword. Me, myself, I've had that issue for 30, 35 years now, where it's a trade-off between taxes and qualifying and credit scores and whatnot. And it's a pain in the rear. It's just not worth it. And being able to buy a home with seller financing, simple, quick, and easy, is so awesome. And so there's tons of good people out there who have money down, who have the ability to make the payment, which is really the key, who are deserving buyers who want to buy a home. So you're not dealing with, subpar people that are trying to buy your home. And there's tons of those out there, I get it, but they're not going to pass the qualification basis anyway. Remember that when a buyer is buying a home in today's world, they have to be run through qualifications. And a lot of people think that because of Dodd Frank, which is one of these things out there we have to think about today in the seller finance world, we have to deal with Dodd Frank, the SAFE Act, some of these federal regulations that may affect us directly in our processing of a buyer and considerations, that it makes seller financing untenable. It doesn't at all. In fact, I actually think it makes it better because it eliminates, one, a lot of the bad actors from the business, and B, it really makes the investor think a little bit about bringing on board a proper buyer. You don't just put somebody in a house because they have a down payment. You want to ensure that they have the ability to repay the loan. We call that the ATR rule under Dodd Frank. Very important. And guys, common sense. You don't make money by selling a house to somebody, foreclosing, taking it back, going through evictions, maybe a bankruptcy, because all of a sudden that down payment you got goes poof and is eaten up with minor repairs or major repairs when you take the house back, missed payments, and all types of things of that nature that out there. So we want to find a good buyer who has the ability to make the payments, because when you do that, you get that long-term reoccurring income, which allows you to repeat on a constant basis Unlike the landlord-tenant world where a tenant stays in a property on average about 24 months, then the house goes vacant for 1, 2, 3 months, maybe more, you got minor repairs. You don't have that in the owner finance world. It's consistent. And we make money through consistency that is out there. So again, we're not dealing with credit challenged people, although there could be some minor issues because of self-employment, as I said earlier. We're not dealing with low-end people. We're dealing with people who just don't want to deal with mortgage companies. And there's lots of that out there for all types of various reasons. They also think that you have to meet what FHA or the traditional mortgage world says for down payments. All you're going to get is a 3.5% down payment. Guys, a 3.5% down payment, in my opinion, is first month's rent, last month's rent, and security deposit. Ain't no way I'm selling a house to anybody with that. I want legitimate down payment, and it is available, and it is out there in the marketplace everywhere. It's just recognizing those items along the way. A lot of people think that if you sell a home with seller financing also, you have no exit strategy. In fact, it's just the opposite. You do have exit strategies, and we call that selling the note. If you own a current home today yourself, and you went to a mortgage company to qualify for your home, 99 to 1, the mortgage company you closed with is not the same mortgage company you're paying today. Very rarely does that happen. That note is sold the very next day, 2 days later, to another long-term holder, and it may have been sold 2, 3, 4 times down the road. In fact, my own personal home was sold 5 times in the first 30 days. It was nuts. I kept getting letter after letter. I don't know what was going on at that point in time, but it did. But understanding your exit strategies for seller financing is great. For me, I want to hold that note as long as possible. You let the borrower pay off my debt, generate that long-term, reoccurring positive cash flow. If the buyer wants to sell or refinance, great. Maybe I make an offer to buy the house back from them even. I might even put a right of first refusal in my mortgage to that borrower so that when they do decide to sell, I get first shot at it possibly. But knowing that I can sell that note into the secondary marketplace, as we call that, to companies that buy these professionally, banks that buy these professionally, IRA holders that buy these, and all types of other people who are looking for a reasonable return on capital, it is available out there. So don't let anybody tell you that owner financing doesn't create and generate wealth. Overcome these myths that are out there that you deal with subpar people, credit challenged people. Dodd Frank prohibits us from doing this. You don't have any exit strategies. You're stuck holding on to this note forever. Absolutely not the case. Take the time, understand it, learn it. I think you'll find it's a great tool for wealth generation. So guys, I hope you liked this video a little bit. Hope it helped you out. If you did, take a minute and like it, please. Make any comments. We'll do our best to answer those for you. Flip over, join our YouTube channel as well, and we'll see you guys next time.